Hi and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi and welcome to the podcast. It is the 19th of December 2022 and I've got a guest presenter today, or a guest host I should say, Hamish Landreth, who often does a bit of an update on the financial markets. He did one about a month or two ago as well, and he's done another one now for us, a great one, talking to Julian Campbell-Wood from Resolution Capital. So talking about property and the international markets regarding property, not so much property you're buying yourself, but really when you're investing in property through your managed investments that you have, whether it be a REIT or something on those lines. And I guess he's talking a bit about the inflation, interest rates, where markets are going globally, Australia, etc. So really good little discussion with Hamish and Julian Campbell-Wood. So Hamish, over to you.
Hi everyone, and welcome to this Fund Manager update. I'm Hamish Landreth, Director and Financial Advisor at Prosperity Advisors. I'm joined today by Julian Campbell-Wood, Portfolio Manager at Resolution Capital. Julian, welcome.
Thanks, Hamish.
Guys, we're really fortunate to have Julian here today. As I said, he's a Portfolio Manager at Resolution Capital. They are responsible for the international property allocation in our client portfolios. Property has been an asset class that a lot of people have been asking questions about recently on the back of rising interest rates and sort of still coming out of the COVID lockdown period, and what does it mean for that asset class? So Julian, we'll just jump straight in, mate. What are you guys seeing? You're looking at this stuff every day. What's your outlook on global property for the next 6 to 12 months?
Sure, thanks, Hamish. So I think it's important just to provide some context to the environment that we've been operating in more broadly. We've seen a pretty synchronized fall in liquid asset prices, whether it's equities, bonds, REITs, etc. And it's really been a case of the market trying to digest what's been the sharpest increase in interest rates really in the last 50 years. We're still dealing with elevated inflation in most of the markets which we invest in. So that's UK, Europe, US, Australia, to a lesser extent in Asia, particularly Japan. But the need for central banks to bring inflation down to more normalized levels has seen real interest rates spike very quickly. And that's caused a drawdown across a lot of asset classes, but also particularly for REITs. But at this point in time, it really has been about that impact on capital markets and the impact on value from rising discount rates. So the REITs have seen a drawdown in the order of 15 to 20% over the last 12 months. And most of that has been a case of cap rates increasing or multiples declining. And when we look at the underlying operations for many of the different property sectors that we invest in the fund, to give you a sense, that range from residential, rental housing, logistics, basic needs retail property like shopping centres, but also things like data centres, self-storage. The operations for most of these businesses are still holding up very well. Consumer spending has held up very well. And we've been touring in many of the markets we've invested in the US, the UK and Europe. And again, the message is very consistent. That what landlords are seeing on the ground is continued strength in underlying real estate fundamentals. So that's demand, that's the ability to lease the buildings, and that gives us comfort in the underlying income and dividend profile of the REITs we've invested in. Now we are facing some normalisation from some of the COVID surge, so rents are normalising in terms of their growth rates from what was exceptional periods in 21 and the start of the year. I mean, to give you a sense, certain logistics markets saw rents up 30-40% in 2021. Rents in US housing have been up 20%. So that's all normalising, but thus far the demand and supply picture has been pretty healthy for the REITs. But what is happening is, given the increase in finance costs, we have seen the availability of finance across real estate decline, and that's having an impact on transaction markets. So the ability for large assets to transact has been more constrained, and that's having some impacts that your investees may have seen in the press. Things like some of the open-ended funds and Blackstone's REIT vehicle have started to restrict redemptions for those funds. So importantly for the REITs, that's not an issue, being liquid, and that's an important attribute in these sort of times. So transaction markets, as a result of some of the dysfunction you're seeing in debt markets, have slowed, and there is an increasing focus on liquidity with some of those issues in private market vehicles. Now, when we look at the outlook, over the next 6 to 12 months, a lot of it is going to hinge rather on the ability for central banks to bring inflation back to more normalised levels, because that's going to dictate, the extent to which interest rates need to increase and the impact on value. But the fundamentals of the REIT sector are pretty good. So we're still seeing healthy demand. Importantly, the supply of new buildings is starting to decline, and that supports returns over the medium term. And the balance sheets, so the amount of debt that is in the real estate vehicles we invest in, is about 25 to 30%. So at a level that enables you to handle some of that cyclicality that you get in real estate markets. So at this point, still a reasonable picture for the listed REITs that we invest in.
Excellent. Julian, I think you made a really important point just before, particularly for our investor clients, in that when you're investing in property, you can go into like an unlisted or an open-ended trust, essentially, which is buying the physical assets. But Resolution Capital is not doing that. You guys aren't holding the physical asset. You're holding listed property companies or businesses, which gives you the ability to sort of transact at any time, essentially. Is that right? Yeah,
that's correct. So your investees have full access to their investment at any point in time. And importantly for us managing the investment, we can transition meaningful amounts of the portfolio to other property types where we see a better risk and reward. So, for example, if we get more concerned on the economic outlook and recession, we increase the defensiveness of the portfolio by moving into whether it's things like net lease, data centres, healthcare real estate, where the profile is more resilient. So that liquidity is an attractive feature both for investees and for us managing the funds.
Yeah, and you just touched on it there, mate. One of the things I like in your strategy is, I think when we talk property, particularly here in Australia, we just default to thinking about the property types that are in our face most of the time, being sort of shopping centres, offices. And I know some people are concerned, well, everyone's doing online shopping now. No one's going into the office. It's all work from home. What does that mean? But that's just a small part of the asset class. And you mentioned data centres, self-storage, medical centres. I guess those types of tenants can't just pick up and leave, can they? They're pretty specialised operations.
Yeah, that's right. And that's what we're trying to find is real estate, which is really providing the space for businesses which are servicing current consumer demand and some of those big secular trends, whether it's the healthcare side, as you touched on, the digitisation economy, logistics, real estate, but even retail. So to give you an example, one of the larger positions in the fund at this point is a company called Kimco. It is a US REIT which owns basically shopping centres, so grocery anchored shopping centres across the US. Very necessity oriented, so you don't have some of that risk around e-commerce disintermediation. But these centres are seeing some of the strongest leasing conditions they have really in many, many years. Vacancies now the lowest in the US for 15 years, and there hasn't been a lot of supply. And the COVID experience really reinforced the retailer demand for this type of real estate. People like going to the grocery shop, and they use the services and the basic needs that these properties provide. And that's seeing the income profile recover very well from some of that COVID disruption and continued leasing demand, even in what are more uncertain economic times. So they are providing that last mile distribution piece for customers and retailers and providing a critical a critical point for these retailers to transact. So we continue to be pretty constructive on that necessity-oriented shopping centre space.
Yeah, great. Well, you mentioned Kimco. Are there any other positions in the portfolio that you're particularly excited about at the moment?
One of the other largest position in the portfolio is a US REIT called Prologis. Prologis is the big behemoth in the logistics world. So in simple terms, they provide sheds, logistics warehouses, whether it's for 3PLs, distribution, but providing the supply chains which keep economies functioning. And the logistics market in many countries around the world continues to experience very strong demand and very strong rent growth. To give you an example, in Australia, the latest data just came out. The vacancy rate in logistics around Australia is about 0.6%. So extraordinarily tight conditions for logistics in Australia, and similar conditions in the US, the UK, and Europe, where we have the investments in the fund. So that just gives the landlords the ability to increase rents and really drive the cash flow, distributions, and total returns of those vehicles. So Prologis is another name where we're still pretty comfortable with the demand and supply outlook and the total returns that vehicle can offer investors.
Yeah, great. Well, Julian, it sounds like, despite a challenging 12 months looking back, and I know the currency hasn't played any favours either, it does sound like, talking to you, that there's still a bit to be pretty positive about from an outlook sense.
Yeah, so what we're seeing on the ground, as we touched on, is there's still a lot of operating strength in many economies we invest in, and that's reflected in what the landlords are seeing. And the big question mark and the big debate is, what is the extent of the slowdown for economies generally, and what does that mean for demand for these businesses? But what we can say is entering what is a more difficult economic environment, the REITs are in a better position than they have been in prior cycles. Leverage is low. Usually at the end of a property cycle, you see too much supply, so too many new buildings, or excess in the finance market. And we're not seeing those things that give us those concerns. So the REITs are in a better position to handle what will be a more difficult economic environment in 23.
Excellent. Julian, really appreciate the update, mate. Thank you for your time, and thanks for talking to us.
Thanks very much, Hamish. Thanks, everyone.
Thanks for joining us today. Really hope you enjoyed that podcast. Thank you, Hamish and Julian Campbell-Wood. For more information about our external guest, please jump on the notes section. You'll be able to find out a bit more about him. And obviously Hamish, one of the financial advisors and directors here at Prosperity. And please follow the series, jump on, have a listen to Hamish's previous update that he did, and all the other podcasts that we've got out there for your prosperity. Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.